Hong Kong, a city of dazzling lights, amazing food, and a skyline that seems to stretch forever. It's a place where East meets West, where tradition and innovation collide on every street corner. And until recently, property prices that could make even a billionaire weep with envy, or maybe frustration. For years, Hong Kong was the undisputed champion of expensive real estate, topping global rankings year after year. Tiny apartments, often called shoeboxes, sold for prices that would get you a mansion elsewhere. Space was a luxury, and every square foot was fought over. People queued for hours, sometimes days, just for a chance to buy. The frenzy was real. Buyers would camp out, hoping to snag a piece of the city. It was a gold rush, except the gold was concrete, and the prize was a glorified closet. Developers couldn't build fast enough to meet demand. But now, the music has stopped. The once bustling sales offices are eerily quiet. The once unstoppable property market? It's tumbling. Prices are falling, buyers are scarce, and the sense of urgency has vanished. Shiny new towers are looking emptier than ever, with lights off in apartments that were supposed to be snapped up in minutes. The city once famous for unaffordable housing is now famous for a property market in trouble. Headlines scream crisis, and uncertainty fills the air. So, what happened? How did the poster child for sky-high property values end up here? What changed so dramatically so quickly? It's not one thing, it's a perfect storm. A mix of economic, political, and social factors all hit at once. Imagine a Jenga tower with too many blocks pulled out. Now it's wobbly and about to collapse. The foundation is shaky, and everyone's holding their breath. This isn't just a minor blip, it's a seismic shift that's rattling the city's core. Some analysts are calling it terminal, the end of an era for Hong Kong real estate. The rules of the game have changed. We're diving into why this is happening, the numbers, the reasons, and what it all means for the city and beyond. Because when a market this big takes a hit, the ripples are global. Investors, homeowners, and businesses everywhere are watching closely. So buckle up. This ride is going downhill, and it's picking up speed. And it's not slowing down. Let's find out why and what the future might hold for Hong Kong's once mighty property market. Let's talk numbers. And not just any numbers. Numbers that are making even the most seasoned investors break out in a cold sweat. Residential home prices in Hong Kong have dropped nearly 30% since their 2021 peak. That's a staggering fall for a city once known for sky-high property values. If you bought a place for 10 million Hong Kong dollars, it might now be worth just 7 million. That's $3 million. Gone, just like that. That's not pocket change, that's life savings evaporating. For many, it's the difference between a comfortable retirement and years of financial anxiety. Even luxury properties on the peak have sold for half of what they were worth just a couple of years ago. The city's most exclusive addresses are no longer immune. 8 homes, to be precise, went for a song, a very sad, discounted song. Auctions that once drew crowds now end in silence. Commercial properties are also on a slippery slope. Office towers that once bustled with activity now echo with emptiness. Shops and offices are being sold at losses of up to 43%. Entire retail strips are dotted with "for rent" signs. One fund management company plans to offload nearly 300 million Hong Kong dollars in assets this year alone. They're not alone. Others are following suit. Location, location, location has become discount, discount, discount. Bargain hunters are circling, but sellers are desperate. Transaction volumes are down too. The market is quieter than it's been in years. In May 2025, property deals dropped by 11% from the previous month, the lowest since February. Each month seems to bring a new low. New home sales saw a slight uptick, but lived-in home sales fell by 15%. Developers are offering incentives, but it's not enough to turn the tide. Fewer people are buying, and those who do are paying less. Negotiations are tough, and sellers are forced to accept lower offers. It's a buyer's market, if you're brave enough to buy. But even the boldest buyers are treading carefully, but the caution signs are everywhere. The frenzy is gone. Optimism has been replaced by hesitation. Now it's all about survival. Agencies are downsizing and homeowners are holding their breath. And the numbers don't lie. Every indicator is flashing red. The market is in free fall. Confidence has vanished and uncertainty rules the day. And there's no quick fix in sight. For now, everyone's just hoping the bottom is somewhere in sight. To understand the dramatic fall, you first need to know just how high Hong Kong's property market once soared, reaching heights that seemed almost impossible to imagine. For 14 years straight, Hong Kong held the title of the world's most unaffordable city for housing, outpacing even global hotspots like London and New York. An average family would need to save every penny for over 2 decades just to buy an average home, assuming they didn't eat, pay bills, or spend a single cent elsewhere. Why so expensive? It's a simple equation. Too many people, too little land. Hong Kong is a city of over 7 million squeezed onto a handful of hills and islands. Scarcity drove prices up, and years of ultra-low global interest rates made borrowing money incredibly cheap, encouraging even more speculation. Cheap money flooded in from all directions, and property seemed like a sure bet, an investment that could only go up. Homeownership became not just a status symbol but a vital investment and a ticket to financial security, fueling intense local demand. Mainland Chinese buyers, seeking a safe haven for their wealth, poured in, snapping up properties and adding even more fuel to the fire. Prices only went up, creating a self-fulfilling prophecy. Panic buying set in as everyone feared being left behind. Developers responded by building smaller and smaller flats, so-called nano-flats, some barely bigger than a parking space or a prison cell, but people still bought them, desperate not to miss out on what seemed like a once-in-a-lifetime opportunity. It was a classic bubble, prices rising far beyond what fundamentals could justify, driven by fear and greed. And as we all know, bubbles eventually pop. Hong Kong's did, spectacularly sending shockwaves through the city. Now the market is paying the price. Once bustling real estate offices sit empty and for sale signs are everywhere. The dream of easy riches is gone, replaced by uncertainty, and a city left wondering what comes next. So, what burst the bubble? Money, and the cost of it. For years, interest rates were low, mortgages were cheap, and borrowing was easy. Then central banks hiked rates to fight inflation. Hong Kong's rates followed the US dollar, making mortgages painfully expensive. Affordability, already a joke, became a cruel punchline. Buyers looked at monthly payments and said, nope. Demand shriveled, and banks tightened lending. The broader economy didn't help. Hong Kong's recovery was sluggish. Economic uncertainty made people hesitant to buy property. If you're worried about your job, you're not signing up for a 30-year mortgage. The stock market's volatility made investors feel poorer, further dampening demand. It's a cycle. Fewer buyers, lower demand, falling prices. The headache just won't go away. High rates, weak economy, and nervous banks, bad news for property. The dream of owning a tiny box in the sky, fading fast, and the pain is spreading, the market's in a bind, and there's no easy way out. The financial hangover is real. It's not just about money. People are leaving Hong Kong. Political uncertainty, especially after the 2019 protests and the national security law, drove capital and people out. Fewer people means less demand for housing. International investors got skittish, and locals started emigrating. Many professionals and families left, selling their properties and shrinking the buyer pool. More homes for sale, fewer buyers, a double whammy. Hong Kong's population is aging and shrinking, with lower birth rates compounding the problem. A smaller, older population means less demand for new housing. The result? More supply, less demand, and falling prices. Political shifts, emigration, and demographics are all squeezing the market. The pool of buyers is drying up, and the pressure on prices keeps building. It's a tough environment for sellers, and for the city. Prices are falling, but homes are still unaffordable for many. Even after a 30% drop, Hong Kong remains the world's most unaffordable city for housing. Overbuilding during the boom years left a glut of unsold apartments. Developers are desperate, offering discounts and incentives to shift inventory. This drags down prices for older homes too. DBS Bank points to high unsold inventory as a reason prices will keep falling in 2025. So despite falling prices, affordability is still out of reach for most. The buyer pool is shrinking, and unsold homes are piling up. It's a recipe for a sustained downturn. Supply far outweighs demand, and there's no quick fix. When the market tanked, the government stepped in. They scrapped property purchase curbs and slashed stamp duties to boost demand. Down payment ratios were relaxed, and taxes on smaller homes dropped dramatically. Did it work? Not really. There was a brief flurry of activity, but prices stayed soft and transaction volumes wobbled. Agents hoped for a boost, but the broader headwinds were too strong. High interest rates and a weak economy still scare buyers away. Oversupply and demographic shifts haven't gone anywhere. Government measures provided a little relief, but no magic bullet. The patient is still sick, the market's problems run deep, and the fixes so far are just band-aids. the slump continues. So what do the experts say? Forecasts for 2025 are all over the place. Some predict a 5% rise, others a 5% fall. It all depends on big ifs, interest rates, US-China relations, and the local economy. DBS Bank expects another 5% drop thanks to all those unsold homes. Some analysts see hope if developers can clear inventory and rates fall. The Hong Kong Interbank offered rate dipped below 1% in May 2025, which could attract buyers. But the long-term view is grim. Some say this slump is terminal. Structural changes mean the market may never return to its old highs. Demographics, politics, and Hong Kong's evolving relationship with China are reshaping everything. The golden age of Hong Kong property may be over, the future is uncertain, and the city is at a crossroads. What does this mean for Hong Kongers? If you bought at the peak, your main asset has shrunk, stressful and bad for the economy. For buyers, falling prices sound good, but high rates and a weak economy make it tough to get in. Renters might see some relief, but rents are still high and changes are slow. The bigger picture is uncertainty. The property market is central to Hong Kong's identity and economy. A prolonged slump hurts confidence, government revenue, construction, and jobs. It could make Hong Kong less attractive to international talent and investment. The city's shine is fading. This downturn isn't just about numbers, it's about homes, savings, and the city's future. Whether this is a temporary correction or a permanent shift remains to be seen. But the days of guaranteed property riches are over. Hong Kong is navigating a new, uncertain landscape, and the world is watching.